صباح الخير. يا رب تكونوا كلكم بخير وبصحة كويسة. Today إن شاء الله we'll be solving sheet 4. Sheet 4 covers chapter 8 that talks about stock valuation. You'll find the sheet with the detailed answers uploaded on Moodle as well. Please, if you have any questions or anything is unclear for you, don't hesitate to send me an email and I'll reply back inshallah. This sheet, like the previous sheets, is divided into 3 different parts: the true or false questions, the problem solving, and the multiple choice questions. We'll begin now by the true or false questions. Number 1, holders of common stocks are entitled, in the event of liquidation of the company, to claim a share in all assets and cash flows before fulfilling the obligations toward the company's creditors, employees, suppliers, and taxes. Yani in case of liquidation, the first to get the rights are the common stocks holders. This is false, as you know that the stockholders, they are called residual owners or residual claimants. That is, they receive what is left after all other claims on the firm income and assets have been satisfied. الclaims دي زي ايه؟ البنك loans and the bondholders, they have to be paid first, then the suppliers and the customers. The equity holder بقى في الآخر, if anything is left after all other obligations are fully paid, they get their claims on the firm's assets and other cash flows. Then it's false. Number 2, in the case of participation in the elections of the board of directors, holders of common stocks with super voting rights are entitled 1 vote per share, in contrast to common stocks with standard voting rights that can provide its owner with more than 1 vote per share. This is false لأن هي العكس. أنا عندي the super voting shares أو the super voting rights, they entitle their owners with multiple votes per share, whereas the common stocks with the standard voting rights provide their holders with only 1 vote per share. في نوع ثالث من الستوكس اللي هي the non-voting common stocks. These stocks, they have no voting rights at all. They are sometimes issued by the firm when the firm wants to raise capital, but at the same time it doesn't want to give up its voting control. وبالتالي it issues these stocks that have no voting rights at all. يبقى it's false لأنه الإجابة هي العكس. Joint stock companies often pay dividends to its shareholders periodically from the company's gross income. لو تفتكروا في ال income statement analysis, we always began by the gross income. We subtracted the operating expenses, then the interest expenses, and then the taxes to reach the net income. The net income, a part of it is kept as retained earnings to be reinvested in the firm, and the remainder is distributed as dividends over the shareholders. Then this is false, as the dividends are distributed from the company's net income and not the gross income. 4. Preemptive rights allows the holders of the common stocks in joint stock companies to maintain their ownership ratios in the facility if the company wishes to issue future shares. This is true, as it gives the current shareholders the right to buy fixed percentages of all the future shares before they are offered to the public in order to maintain the same ratio in the facility. 5. The bonds have a specific maturity date known in advance on issuing the bond, in contrast to the stocks that have no specific expiry date. This is true. The bonds, as you know, their maturity date is determined as at issuance, after which the firm has to repay back to the bondholders the par value, whereas the stocks, they are permanent sources of financing. They have no maturity date and they never have to be repaid by the firm to the stockholders. 6. Roughly, the share price can be calculated as the present value of the expected future cash flows for both the future sale price in case it was sold on the secondary market and dividends if any. طيب لو تفتكروا when you used to calculate the price of bonds or the present value of bonds, we used to discount all the cash flows that are expected from holding the bonds. These included the coupon payments and the par value received at maturity. We do the same for the stocks. We have to, in order to calculate the fair value of the stock, we need to discount all the cash flows that are expected from holding the stocks. This includes the dividends, if the company will pay any, we have to discount them, and the future sale price in case you decide to hold the stock for a certain time and you're planning to sell it in the secondary market. Then it's true. Question 7. In a constant dividend model with an infinite horizon, dividends are assumed to be the same for all shareholders and to be continuously distributed indefinitely. This is true, as the constant dividend model, it assumes a constant non-growing dividend stream. يعني the dividend distributed in year 1 is equal to the dividend distributed in year 2 equal to the dividend in year infinity. 8. The main difference between the two models for the distribution of constant dividends with a finite horizon and infinite horizon lies in the holding period of the share, which is temporary for a specified period in the first case and perpetual in the second case. This is true إنه the two models they assume constant dividends. الفرق ما بينهم هي في holding period of the share. Finite horizon, it assumes that you will hold the stock for a certain period of time and then you will sell it to another investor, whereas the constant dividends model with an infinite horizon assumes that you will be holding this stock forever. It's true. 9. The constant dividend model with an infinite horizon is called the Gordon model. This is false. The constant growth dividend model with an infinite horizon is called the Gordon model after the name of its developer. أنا عندي constant dividend model و constant growth dividend model. إيه الفرق ما بينهم؟ الكونستنت ديفيدند موديل ده اللي كنا لسه قايلين عليه من شويه اللي هو it pays a constant dividend. يعني it assumes that the dividend are constant, they do not grow. D1 equal to D2 equal to D infinity. The constant growth dividend model, it assumes that the dividends they grow at a constant rate G. يعني this year we're distributing D0. The next year we will be distributing D0 multiplied by 1 plus G. Year 2 we will be distributing D1 multiplied by 1 plus G. Third year we'll be distributing D2 multiplied by 1 plus G, and so on. The constant growth dividend model with an infinite horizon is the one called the Gordon model. 10. Common stock shares have a predetermined last known value at the time of issuance, other than bonds whose last value is not known precisely until the time of their last sale. It's false. It's the opposite. Common stocks shares, the last value is not known precisely until the time of their last sale, whereas the bonds, they have a predetermined last known value at the time of issuance, which is their par value. And now we move to the second part, which is the problem solving. قبل ما نبتدي في الحل كنا لسه بنقول من شوية إنه in order to calculate the fair value of any stock, you need to calculate the present value of all the future cash flows that are expected from holding this stock. طيب كانت إيه ال cash flows that are expected from holding any stock؟ This include the dividend payment, if any, and the selling price of the stock if you're planning to hold it for a certain number of years and then sell it to another investor. فده هيخلينا نتكلم على 4 different models of stock valuation. الاختلاف ما بينهم بيختلف طبقا للassumptions بتاعتهم concerning the dividends, whether those dividends they are constant أو they grow at a constant rate G, and the holding period of the stock, whether you're holding this stock indefinitely أو forever أو you are holding it only for a certain number of years and then selling it to another investor. Question number 1. Really, the International Company for Import and Export distributes indefinitely quarterly dividends of 2.15 pounds per share. Investors expect a rate of return on investment of 8.75% annually. Calculate the selling price of this company's share using both the annual and quarterly data. Then find the value of buying 100 shares of this company. دايما قبل ما نبتدي نحل لازم نطلع الأول the givens from this problem in order to be able to decide which model we will be using. أول حاجة هو بيقول لي this is quarterly dividends. We have the quarterly dividends equal 2.15 pounds. The annual rate of return on investment is 8.75%. وعايزني أحسب ال fair value أو the selling price of this stock. يبقى أنا هنا عندي constant dividend ما جابليش سيرة إن أنا I'm holding this stock for a number of years and then selling it to another investor. يبقى we will assume that this is a constant dividend model with infinite horizon. ده الرول بتاعه اللي هو ايه ده زي فكرة البربيتويتي. البربيتويتي لو تفتكروا في التايم فاليو of money كنا بنتكلم على equal periodic cash payments that are paid forever. دي نفس الفكرة، دول equal dividends that are paid forever، وبالتالي هنطبق عليها الرول بتاعت calculating the present value of a perpetuity. الرول دي كانت the payment over R the periodic cash payments اللي هي في in our case هنا هي ال dividend divided by R اللي هو required rate of return. بس when solving and when computing a perpetuity we have to make sure that both the payment and the discount rate they represent the same period. يعني لو أنا بتكلم على quarter dividends يبقى I have to convert my rate of return on investment to quarter rate أو العكس إن أنا أحول ال quarterly dividend بتاعتي ل annual dividend. طيب احنا دلوقتي عندي الكوارتر ديفيدند هي كانت ب 2.15 وبالتالي we have to restate the annual required rate of return as quarterly. we will divide the 8.75% by 4 ده هيدينا 0.02185 and then we will apply the rule of the perpetuity اللي احنا كنا لسه بنقول عليه اللي هو the present value of the price is equal to the dividend payment divided by the required rate of return. فعندي the quarterly dividend is equal to 2.15 divided by the quarterly rate of return اللي هو 0.02. This gives us a price of 98.2857 pounds أو LE. لو أنا كنت بالعكس حولت ال dividends دي into annual بأن أنا ضربتها times 4 ده هيطلع لي نفس الإجابة لأن أنا لو بصيت على الرول أنا هنا كنت مستخدمة في الأول the quarterly payment and the quarterly rate of return عشان أحولهم annual كنت هضرب فوق times 4 numerator times 4 and the denominator times 4 فas if إن أنا ما غيرتش أي حاجة فأنا لو استخدمت the annual rates instead هيطلع لي نفس الأنسر اللي هي 98.28. طيب أنا كده جبت the fair value أو the price of the stock. فلو عايزة أعرف the value of buying 100 shares of this company I'll multiply the price per share اللي هو 98 times 100 فبالتالي the cost of 100 shares is equal to 98 times 100 اللي هي 98 9,828. Question 2. An investor wants to get an annual return of at least 10% on his invested funds. If you know that the Arab Transport Company pays quarterly dividends of £2 per share in perpetuity, whereas the Gulf Tourism Company pays semi-annual dividends of £5 per share, then calculate the purchase price of each of the shares for the investor. This problem has exactly the same idea as the previous one. We have constant dividends that are paid in perpetuity. Therefore, we're talking about our first model of stock valuation, which is the constant dividend model with an infinite horizon, as long as in the question it hasn't mentioned that the stock is held for a certain period of time. We just need to make sure when solving this problem that we adjust our dividend payments and the rate of return on investment so that they both represent the same period. So for the first company, the Arab Transport Company share price, the dividend given is quarterly dividend equal to £2. Therefore, we will convert this dividend to annual dividend. We will multiply the 2 by 4 and we will divide it by the annual rate of return of 10%. This gives us a share price of £80. Or instead, we can convert the annual rate of return into a quarter rate of return. We divide the 10% by 4 to get a quarter rate of return of 0.025. Then we divide the quarter dividend of 2 by 0.025. We get the same answer of £80. We will do the same for the other company, the Gulf Tourism Company. But here the dividend given is semi-annual dividend, not quarterly as the first company. Therefore, we will convert this semi-annual dividend to annual by multiplying the 5 by 2 and then dividing it by the 10%, which is the annual rate of return. We get a share price of £100. We can instead also divide the annual rate of return by 2 to get the semi-annual rate of return, which is equal to 0.05. Then we divide the semi-annual dividend payment of 5 by the semi-annual rate of return of 0.05, and we get the same answer of £100 per share. If we're calculating this fair value of the stocks, in order to compare it to the market price and make a decision whether to buy this stock or not, we will do the same as we did with the bonds. We will compare this fair price to the market price. If the fair price of the fair value we have just calculated is greater than the market price, this means that this stock is undervalued. It has a market price that is less than its real value. Therefore, you should buy this stock. You know that eventually its price will have to increase to reach its fair value, and therefore you will be making a capital gain. On the other hand, if you are an investor who is selling this stock and you found that the market price is less than its real value, then you shouldn't be selling this stock now, as when its market price will increase, you will have accomplished a loss. If the fair value is less than the market price, this means that the stock is overvalued, its market price is greater than its real price, then you shouldn't buy the stock, as eventually the market price will decrease to reach its fair value and you will be making a capital loss. And the opposite if you are a seller. If you are a seller and you found that the market price is greater than the fair value, you should sell this stock immediately, as eventually its price will decline and you will be losing if you didn't sell the price. The rule in the stock market: always buy low and sell high. Question 3. Assume that the United Contracting Company pays quarterly dividends worth £4 indefinitely. An investor plans to buy a share in this company and hold it for 8 years, after which it is expected to sell at £40. Knowing that the required annual rate of return is equal to 14%, what is the expected price for this company's share? Here we're talking about the second model for stock valuation. We have a constant dividend, but you're planning to hold this stock for a certain number of years and then sell it to another investor. But in order to calculate the value of this stock, we need to calculate the present value of the dividends that you're getting for the next 8 years and calculate the present value of the future selling price at which you are going to sell this stock. But our rule is divided in such case into two parts. The first part that you will have to calculate the present value of the dividend payments you're getting for the next 8 years, and then you will calculate the present value of the future selling price, which is equal to 40 pounds. This is exactly the same as the rule of the bond, where we used to calculate the present value of the coupon payments and the present value of the par value that you get at maturity. We have a lump sum amount, which is the future selling price, and we have annuity, which is the periodic dividend payments. Before applying our rule, we need to make sure here that we convert our annual rate of return into a quarterly rate by dividing the required rate of return of 14% by 4. And we also need to multiply our holding period of 8 by 4 to get the quarterly data. Then we will just substitute with our values in the rule for the present value. As you can see, it is divided into two parts. The first part is the present value of a lump sum, which is the future price. The second part is a present value of an annuity, which is the dividend payment. For the first part, the future selling price is equal to 40 divided by 1 plus 0.035, which is the quarterly rate of return, to the power 8 times 4, 32, to get the present value of the future selling price, plus the payment, our quarterly dividend payment 4 divided by 0.035 multiplied by 1 minus 1 over 1 plus 0.035 to the power 32. We get a share price of 89.57. Question 4. The expected rate of return on investment in the road transport company is about 13% annually. If you know that the company will not distribute dividends until year 10, after which it is expected to distribute dividends at £5 per share at an expected permanent growth rate of dividends of 5%. Calculate the share price of this company at the end of the 10th year. Then calculate the present value. This question is divided into two parts. The first part until year 10, where the company does not distribute any dividends. The second part starts year 10. The company starts to distribute dividends. The dividend at year 10 is equal to £5. Then the dividends will grow at a constant rate of 5% indefinitely. Here we have moved to our third model of stock valuation that assumes that the dividends, they are not equal, but they grow at a constant growth rate indefinitely. هنا ما عنديش holding period after which I will sell the stock. لا, هنا it assumes that the stock is held forever and the dividends are growing at a constant growth rate. In order to calculate the share price at year 10, I have to calculate the present value of all the expected future cash flows. بما معنى ان انا لازم اعمل discounting to all the dividends expected from this stock which will last to infinity. يعني هاجي عند الديفيدند بتاع السنة الأولى, dividend of the first year, واعمل لها discounting. Since the second year is not equal to the first year, يبقى I have to discount the dividends of the first year plus the dividends of the second year على 1 plus r square. then the dividends of the third year على 1 plus r to the power 3 to infinity, d infinity, divided by 1 plus r to the power infinity. If you go back to the lecture slides, you will find that this rule will simplify to the following formula. PT, the price at year t, is equal to dividend at year t plus 1 divided by r minus g. That is, the price at year 10, which I want to calculate, is equal to the dividend at year 11, which is the dividend expected at the following year, divided by r minus g, which is the rate of return on investment minus the growth rate of dividends. هنا given in this question, I have the dividends at year 10. How to get the dividend at year 11? We have a growth rate for the dividend is equal to 5%. Therefore, the dividend at year 11 is equal to the dividend at year 10 multiplied by 1 plus the growth rate. After we get the dividend at year 11, we divide it by r minus g, and we get the price at year 10. Similarly, we can say the rule, the price at year t is equal to the dividend at year t multiplied by 1 plus g, which is dt plus 1, divided by r minus g. We have d10, which is given 5 pounds. We multiply it by 1 plus the growth rate, 1 plus 0.05 divided by r, 0.13, minus the growth rate, 0.05. By substituting with these values, we get a share price of 65.625. After we get the price of the stock at year 10, the question asks to calculate the present value of this stock, and the price of this stock today. For the next 10 years, this stock is not paying any dividends. Therefore, the price of the stock today is simply the present value of its price after 10 years. So we will just discount P10, or the price after 10 years, and we will get the present value. We have a lump sum value, which is P10. We will divide it by 1 plus r to the power 10, and we get the present value today. The future price, which is P10, we divide it by 1 plus r, which is 1.13, to the power 10. We get the price today of this stock, which is equal to 19.332. Generally, to calculate the dividend at any time t, we use the following formula. The dividend at year t is equal to dividend 0 multiplied by 1 plus g to the power t. جت منين دي؟ نفس فكرة لما كنا بنحسب ال future value وكان عندي compound interest rate. نفس الفكرة. أنا عندي the dividend at year 1 is equal to dividend 0 multiplied by 1 plus g. طيب dividend at year 2 is equal to إيه؟ the dividend بتاع السنة اللي قبلها اللي هو D1 multiplied by 1 plus g. احنا لسه قايلين ان D1 دي هي عبارة عن ايه؟ D node في 1 plus g. فيبقى انا كده عندي D node في 1 plus g في 1 plus g. يبقى كده D2 is equal to D node في 1 plus g square, and so on. This gives us the general rule. Dividend at time t is equal to dividend 0. Dividend 0, this is the last distributed dividend, multiplied by 1 plus g, the growth rate of the dividend, to the power t. Question 5. المشرق العربي issued par value preferred stocks of $250 per share and constant dividend yields of 8.25% per share. If you know that the present value of this preferred stock is $260, calculate the rate of return for the preferred share of this company. طيب احنا عارفين انه the preferred stocks they offer fixed periodic dividends to infinity. Therefore, In order to calculate the present value of the preferred stocks, we will just apply the rule of calculating the present value of the perpetuity. لأن عندي fixed payments that last forever. Therefore, the present value of the preferred stocks will be equal to the present value of perpetuity, which is equal to the periodic payment divided by the required rate of return. This is exactly the same as our first model for stock valuation, which assumed constant dividends with an infinite horizon. Let's extract our data from the problem. We have the par value preferred stock equal to 250. The dividend yield is equal to 8.25%. The present value of the preferred stock is equal to 260, and the question asks us to calculate the required rate of return for this preferred stock. First of all, we need to calculate the periodic dividend payment. We have the par value and we have the dividend rate. Therefore, we multiply this dividend rate by the par value to get the annual dividend payment. Therefore, the annual dividend payment is equal to 0.0825 multiplied by 250, which gives us 20.625. We have our rule. The price is equal to the payment divided by R. We have the price and we have the payment. Therefore, we can solve for R. R will be equal to the payment divided by the price, which is equal to the payment is, we have just calculated the payment, the dividend payment of 20.625. We will divide it by the price, which is equal to 260. We get 7.93%. The required rate of return for this preferred share is 7.93%. Question 6. The Brothers Company distributed an annual dividend of £6 per share after a good performance during the previous year, which raised the expected annual dividend growth rate to about 10%. Given that the shareholders expect a rate of return of up to 14%, calculate the selling price of this company's share. In this problem, we have a dividend that grows at a constant growth rate of 10%. And the problem does not mention anything about holding the stock for a number of years. Therefore, here we're talking about our third model for stock valuation, the constant growth dividend model with infinite horizon. We have D0, the last distributed dividend is equal to £6. We have the growth rate equal to 0.1. We have the R is equal to 0.14. We just substitute with those values. We just substitute those values in our formula. P0 or PT is equal to dividend 0 or dividend T multiplied by 1 plus G divided R minus G. The price is equal to 6 multiplied by 1 plus 0.1 divided 0.14 minus 0.10. This gives us a share price equal to £165. If the problem instead says that the Brothers Company expects to distribute a dividend next year of £6 and it is expected that this dividend will grow at 10%. لو قال لي it expects to distribute the dividend for next year is £6. Therefore, هنا the given is D1 and not D0. So in such a case, the price will be equal to D1 divided R minus G. We don't have to multiply this time by 1 plus G. Then we said it's either DT plus 1 over R minus G or DT multiplied by 1 plus G divided by R minus G. Question 7. High Seas Trading Company issued preferred shares with a par value of £80 per share and semi-annual dividends of 6% of the par value. If an investor wants to obtain 12% annually as an expected rate of return on investment, how much will he pay to buy one preferred stock? This is a stock valuation problem for a preferred stock. We just need to make sure that we're using the payment and the rate of return for the same period. Therefore, we're either convert the semi-annual dividend into annual dividend and divide it by the annual rate of return, or convert the rate of return into semi-annual and use the semi-annual dividends. So we have the par value is equal to 80, the semi-annual dividend rate is equal to 6%, and the required rate of return is equal to 12%. Therefore, to get the semi-annual dividend, we multiply the semi-annual dividend rate by the par value. This gives us a 4.8 dividend payment, a semi-annual dividend payment. We divide this semi-annual dividend payment of 4.8 by 0.12 over 2. ليه 0.12 over 2? لأنه here we have to convert the rate of return into semi-annual. So we divide the annual rate of return of 0.12 by 2, and then we divide the semi-annual dividend by the semi-annual rate of return. We get £80. Question 8. If you know that the present value of a company's common share is £45 and the value of its last recent dividends, يبقى هنا D0 is £2 per share, and the required rate of return is 15%. What is the dividend growth rate under the constant growth dividend model with an infinite horizon? هو هنا محدد لي ان هو عايز يجيب the growth rate under the constant growth dividend model with an infinite horizon. يبقى انا هشوف ايه الجيفن عندي واشوف ايه اللي ناقص في الفورمولا in order to be able to calculate the G. We have the present value of the company's common share, P0, equal to 45. We have the last recent dividend, D0, equal to 2. We have the required rate of return, 15%, and the question asks for G. Since we have P0 equal to dividend 0, 1 plus G divided R minus G, we have P0, we have dividend 0, and we have the R, then we will solve for G. This gives us a value for the growth rate equal to 10.11%. Similarly, we can say G is equal to P node multiplied by R minus dividend 0 divided by P node plus dividend 0. This is derived from the previous rule, and you just substitute with the values in this rule, you get the same answer of a growth rate of 10.11%. Question 9. The Crescent Corporation just paid a dividend of $2 per share and is expected to continue paying the same amount each year for the next 4 years. If you have a required rate of return of 13% and plan to hold the stock for 4 years and confident that it will sell for $30 at the end of 4 years, how much would you offer to buy it today? Now we have a constant dividend stock that offers $2, and you are expecting to hold the stock for only 4 years. Then here we're talking about our second model for stock valuation, the constant dividend model with a finite horizon. We have our D0 is equal to 2. We have our holding period equal to 4. The required rate of return equal to 13, and a future selling price of 30. Then to calculate the present value of this stock, we have to calculate the present value of all the cash flows expected from this stock, which are the dividend payments for the following 4 years and the future selling price. the present value is equal to the present value of the future price plus the present value of the dividend stream. The future price, it is a lump sum that we will apply the formula of a lump sum on it. Future price divided 1 plus r to the power n, and this dividend stream is an annuity. By substituting with these values in the formula, we get a price of the share of $24.35. Question 10. The ANZAC Corporation plans to be in business for 30 years. It announces that it will pay a dividend of $3 per share at the end of 1 year and continue increasing the annual dividend by 4% per year until it liquidates the company at the end of 30 years. If you want to earn a rate of return of 12% by investing in ANZAC stock, how much should you pay for this stock? This problem says that the corporation will be paying a dividend of $3 for the first year, and then this dividend will grow by a constant growth rate of 4% per year for 30 years, after which the company will liquidate. And the company will continue to pay dividends for its shareholder for 30 years, and those dividends will grow at 4% per year. This brings us to our last model for stock valuation, which is the constant growth dividend model with a finite horizon. The constant growth dividend model with a finite horizon, it assumes that the stock pays a dividend that grows at a constant growth rate, and you will be holding this stock up to a specific number of years, and then you will sell it to another investor. Looking back to your lecture slides, or in this slide, in the end of the slide, the formula for this model is dividend 1 divided by r minus g multiplied by 1 minus 1 plus g divided 1 plus r to the power n plus price at time n divided by 1 plus r to the power n. The first part of this formula calculates the present value for the growing stream of dividends that will be received for the coming 30 years. The next part of the formula calculates the present value of the future selling price. However, in this problem, it says that the company will liquidate at the end of 30 years. Therefore, مش هيبقى في شركة أصلا بعد 30 سنة، وبالتالي مفيش سعر للسهم بعد 30 سنة. I don't have a future selling price. This formula for this problem will simplify only to the first part. لو كان في السؤال بيقول لي إن انتوا you're selling the stock of this company after 30 years for an amount equal to y, كنت هتحط the present value of this amount y هحسبها في الجزء التاني من البروبلم. However, this problem مفيش future selling price لأنه the company will liquidate, we will use only the first part of the formula, which calculates the present value of the future growing stream of dividends. بس هبتدي أعوض بالجيفن اللي عندي الجيفن values اللي عندي في الفورمولا. dividend 1 $3 divided by r minus g 0.12 minus 0.04 multiplied by 1 minus 1.04 divided 1.12 to the power 30. This gives us a share price of $33.44. Part B of the question says, if the company was to announce that it would continue increasing the dividend at 4% per year forever, how much more would you be willing to pay for its stock, assuming your required rate of return is still 12%? Instead of liquidating the company after 30 years, the company will continue to pay the dividends at a growing rate of 4% to infinity. Therefore, now we're talking about the constant growth dividend model with an infinite horizon. Substituting in our rule, P0 is equal to dividend 1 divided by R minus the G. We have D1 is equal to 3 divided by 0.12 minus 0.04. We get a share price of $37.5. We're now moving to our third part, which is the multiple choice questions. Question number 1. The right of shareholders to claim a share on the residual assets and cash flows after fulfilling all the obligations towards the creditors, employees, suppliers, and taxes is known as, in the event of liquidation of the company. As we have said in the true or false questions, the right of the shareholders is called the residual rights. They are residual claimants on the assets of the company. It's B, residual rights. Number 2, in the case of voting to make significant changes in the company's structure, what can provide its owner with greater voting power, more than one vote per share, and thus greater ability to enforce or not enforce the proposed changes? Here we're talking about the super voting shares that entitle their owners with multiple votes per share or more than one vote per share. So the answer is C. Number 3, the advantage granted to common stockholders in joint stock companies that give them the right to purchase a fixed percentage of the future share issues before they are presented to the public is called, this is the preemptive rights. A. Question 4. As an owner of, I know exactly the size of cash flows and the number of periodic repetitions, in contrast to the owner of, who does not have specific information about the size of the cash flows and the number of periodic recurrences. The one who knows exactly the size of the cash flows and the number of periodic repetitions is the bondholder. The bondholder knows from day one he buys a bond, he knows the coupon payments he's getting, and he knows the maturity date. Whereas the stockholder, he doesn't have specific information about the dividends he will be getting, and it has no maturity period. The company may or might not distribute dividends over the stockholders. Therefore, the answer is B. The first part is the bond and the second is the stock. Question 5. It is an ownership instrument that pays its holder a constant dividend and its owner gets priority over the common shareholder in the event of liquidation of the company. As we have said previously, that the preferred stock is the type of ownership instrument that pays a constant dividend, and in case of liquidation they have a priority over the common stock holders. أول ناس ليهم priority البوند holders، يجي بعدهم the preferred stock holders، وآخر حد هو common stock holders. It has the properties of both the bonds and stocks, similar to the bonds in that it provides a fixed periodic payment, and similar to the stock because it is an ownership instrument. We now come to the end of this sheet. Thank you for listening. Please send me if you have any question or need any further clarifications.